back. You're listening to the USA Radio Network. My name is Lee Elci, filling in for Wayne Allen Root. So a special guest joining us. All guests are a little bit special. This is Tony D'Angelo, and he represents the Fortress Fiduciary Company, a division of Paragon Trust. And we're here to talk about money, which I don't have enough of and I don't know a lot about. So, Tony, let's talk about money, what to do with it, where to put it, how to store it, where to keep it, if, in fact, you're lucky enough to actually have it. You're going to tell us all of the right investments to make in 10 minutes or less.
Well, actually, I'm going to look at it a little bit of a different way. And it's when you look at what is out there to invest in, stocks, bonds, annuities, autos, real estate, funds, collectibles, jewels, you come to one conclusion. Nothing in and of itself is right for any one person necessarily, or is something that is there that is good, perhaps for me, may not be for you. And the important thing you have to ask yourself is, if I get involved with something, is this right for me with the type of life I have? I look at it quite another way. My dear IT guy came to me the other day and said, I'm getting an inheritance from my mother, and I want to buy a certain thing. And I said, Joe, not his real name, what is your personal debt? And he told me what his personal debt was. I said, well, the first thing you need to do, my friend, is pay down your personal debt, because when you're paying down a credit card at 20%, 25%, or whatever, that's actually a return on your money of 20% or 25%. And from there, you don't invest that money. You take that money and you put it in the bank, and you start to study things and you start to learn about them. And that's how you get on base. So that's really number one. Number two is, when you start to think about what is this thing that's right for me, can you sell it? Again, it's the buy window theory of life. It's only as valuable as what somebody will give you for it on a certain day. That's the first two fundamental investments. And it's really funny that when we think of automobiles, we think of vehicles. We think of little cars, big cars, trucks, SUVs, the whole gamut, the whole group of fine cars one can buy. We often use the term investment vehicle. And the first thing we think of in automobiles is not every automobile vehicle is right for every single person. Look at people driving around with these huge trucks, and what do? They go to an office job and back with a big truck. Then again, not one investment vehicle is right for any one given person necessarily. Those are the first two premises.
Okay, so somebody out there listening to us right now doesn't have any investments, wants to start. I know it's hard when you don't have, their income or anything like that, but I mean, okay, I'll be more specific. I'll just run a couple of things at you. So annuities, give me a breakdown of annuities.
An annuity is a tax-deferred vehicle that is comprised of certain investments within the vehicle. It could be an aggressive annuity, which is primarily funded with aggressive stocks that are very market sensitive, or a more stable type of thing that might have more dividend-paying stocks, like large corporations that pay dividends, Coca-Cola or Exxon, things like that. So the first thing when looking at an annuity is, and I'm very glad you hit on that, what is my risk tolerance? In other words, can I watch this thing go up and down and up and down and up and down and not have an ulcer every time it does, and be able to put that aside? Or am I looking for something that's more stable, where I don't want to feel that I'm gaining a lot of money and losing amount of money every single day? So an annuity is really kind of like a capsule. It's sort of like a piece of pizza that has a whole lot of stuff on it, and the type of piece of pizza that you have is really the type of piece of pizza that you want to have, whatever your risk tolerance is.
Oh, see, I was always under the impression that an annuity was the safest bet. You park it, you get like 5% back on your money every year. Doesn't matter what the stock market does. It continues to go up. There's almost no risk, but a very moderate reward.
There are guaranteed annuities. You're absolutely right. One of the things I do want to say, though, is not every guarantee is an absolute guarantee forever and a day. 95% of the time, you're absolutely right. But I had people during the financial crisis who were in AIG annuities, and there was a time when they couldn't get a red cent out of the thing until the government had gone in and bailed them out. It's a very, very, very rare occurrence. I understand that. But it's not to say it couldn't happen again. But yes, the general premise is correct. If it is a guaranteed annuity from a reputable national firm,
and basically that's what 3, 4, 5% a year. Is that how that works?
Modest. Yes. And if you have an annuity, many times you'll be approached by people who have an annuity with a better yield, and what are you doing in that? And I tend to get that a lot. And all well and all good. However, when you buy an annuity, when you actually get to the game, you are paying a sales charge. I mean, you should. And when you exchange the annuity, you pay another sales charge. So those are things you have to really look at in hard dollars. Where am I actually ending up? Not, is this a better investment for me?
What about somebody who doesn't have the access to a 401k through work? If, they were coming to you and they wanted to start saving for retirement, like I said, I know this is an infinite number of things you could give them, but what would you advise them?
First thing to do is get your spending under control, and get your objective right in terms of what you want to do. If you're asking for something specific, I would get into what type of things they really want to have, what type of an income they really want to have, what they see doing themselves in retirement. Retirement these days is not necessarily the gold watch and, you get to go to the ball game 3 times a week. Retirement could be, working with a nonprofit, working part-time, consulting. Whatever it is, Lee, it has to fit within that block.
How about the stock market? See, it seems like, you look at the stock market, it's very up and down right now. It still seems like it's light years beyond where we ever thought it was going to get to, which leads me to my question. If you're a new investor, would you dabble in a stock market that already seems like the balloon is about to break on it?
Well, think risk reward. Think if I put this money in the market and I come home one day and something terrible happens between Trump and China, can I look at this to say, I lost 7% today, but I know in the long run I'll be okay. It's the type of thing where you need to study what it is you're investing in and become familiar with it and know how it's going to behave. Like, I've been a big fan for years of good American branded companies because I've always said to myself, well, they have worldwide recognition. Believe me, last Friday, they weren't drinking a lot of Coke in China, let me tell you. But it's the kind of thing to say, well, what's the long-term prognostication for this? So watch your percentages if you're going to have a lot in, but if you're going to do it, Lee, if you want to get involved in it, start small and study. Pay attention. Don't think this is, Ron Popeil said it and forget it. It isn't.
What about the idea of people trading themselves online, things like that, taking that middleman out of the mix?
I think it's good. I think it's good to get familiar, but I think it's also good to have someone you can go to, and I'm very glad you brought that up. There's many, many, many people who are out there who are investment advisors. There's different ways they can be compensated. Not one way, be it fee-based or commission-based or whatever it is necessarily better than the other for many, many, many reasons. But once you yourself become familiar, then you can actually approach someone, and then you'll know if they're telling you the truth or not, or if they just want to sell you something.
All right, one general piece of advice for somebody, something simple like the age of retirement gets here before you know it. Start saving today. Give me some piece of advice you'd tell everybody.
The best thing one can do, and I was looking at this today, look at all the athletes, look at all of the entertainers who ended up flat broke, Darryl Strawberry, Kurt Schilling, Mike Tyson. Money alone does not solve your problems. And I hate to tell you that, folks, but it really doesn't. And if you yourself are not really prepared to accept money, you will get into a bigger hole than you ever did. And this is what I've always counseled widowers and widows. Because what happens? You have a bereavement, so it's emotion. And generally what happens after that is money comes in from something sold or an insurance policy, whatever the case may be. And I scream at them and I tell them, don't do a thing for a year. Don't get involved in a relationship. Don't buy a car. Don't move from your house. You will make the right decisions in a year when your emotions are out of it.
All right, Tony, it goes fast. We're out of time. I thank you. As always, my name is Lee Elci. I'm filling in for Wayne Allen Root. You're listening to the USA Radio Network. The show is raw and unfiltered.